welcome to the July edition of our economic and investment updates. My name's David Baker. I'm Partner and Chief Investment Officer here at Mazars, and I'm joined as ever from Athens by George Ligarius, our Chief Economist. Thank you for choosing to spend your time with us this morning. We do appreciate it. We've got a few pre-submitted questions which we're very grateful for, but please do feel free to put any questions that you might have in the Q&A tab. That's in the Q&A tab as opposed to the chat tab, and we will try and pick up as many as we can when we get to the end of the session. So I'll just give a little recap on what's happened in markets over the last few months, and then George will take us through the bulk of the presentation, talking about what's happening in economies generally. So 2022 was a pretty miserable year for investors, but if we go to the next slide, we can see that actually 2023 has been an awful lot better. And we sort of said this with a degree of nervousness earlier in this year that, you know, without making particular comment on the state of markets themselves, it's very unusual to have one poor market, one calendar year poor market followed by another. You know, it's not usual that the markets get it so wrong that they have to have 2 calendar years of poor performance. So you can see, you know, towards the left-hand side of that chart, 2022 pretty miserable if you were in a fairly standard portfolio, 60% equities, 40% bonds, losing close to 20%. This is in US dollar terms. But 2023, much better. We've seen good returns from equities generally, maybe not so much in the UK, but certainly in the US, and we'll talk a little bit more about why that's been the case shortly. And actually in Japan as well, much more concentration in Japan around certain aspects of corporate governance and indeed returning value to shareholders. So Japan had a very good first half of the year. You know, worth saying as ever, when you're investing in overseas markets, you're very much affected by currency movements. And as you may well have seen, the pound has been very strong so far this year. So always worth hedging some of that currency effect if you're investing overseas, and indeed that we do that within our portfolios. So, you know, good start to the year from equities, or I say start, we're 8 months into the year nearly now, and also for bonds. Again, not necessarily in the UK, where the interest rate environment, the inflation environment is very different to most other developed markets, and therefore you've seen greater expectations of more interest rate rises, which have affected gilts and bonds, but certainly elsewhere around the world, you know, with interest rate cycles expecting to be at or near their peak, we're starting to see good value given back to investors who are holding bonds and sovereign debt in those other countries. So, you know, hopefully we can leave behind the poor returns of 2022, and 2023 will continue to deliver. So that's a sort of overview from a balanced portfolio perspective, and all of that delivered actually against a backdrop of continuing tighter monetary policy. And in particular, what we're looking at on this chart is quantitative tightening. So we spent a lot of time over the last 10 years talking about quantitative easing, central banks putting money into the financial system with no particular target in mind, really just flooding the system with liquidity in order to, first of all, save the financial sector and the banking sector after the global financial crisis, and then really finding themselves, you know, addicted to that method of helping the economy and building up huge balances within central banks. And you can see the scale on the left-hand side. You know, it doesn't start at 0, it starts at about 7.8 trillion. And this is the US Federal Reserve's balance sheet. And you can see from the middle of last year, they started to reduce that gradually but consistently, and that has continued, and we expect it to continue for some time. Obviously, there is the big spike in the chart, which is the money that the Fed put to work when you had Silicon Valley Bank and First Republic Bank getting into trouble, and to stop a contagion in the US banking system, they again threw money at the problem. However, it's really important to note that this was not This was a very deliberate, targeted injection of liquidity, providing credit in their role as the lender of last resort to some very specific banks who were in trouble. And it wasn't just, as we'd seen in recent years, putting money in the market, buying bonds from the whole system. So, the fact that we've got good investment returns, despite the fact that we've got quantitative tightening that's taking money out of the system, it is a real positive, and just hints at some of the resilience that we've seen in economies despite interest rates going up. So we still have very high levels of employment in most of developed markets. We've seen resilient consumers, and generally speaking, albeit corporate returns haven't been stellar, they've been ahead of expectations and reasonably resilient as well. So good returns against a challenging backdrop. I mentioned that the US equity market had done particularly well. And it's really worth bearing in mind what that looks like underneath the bonnet when you actually look away from just the broad index. So what we're looking at here is a comparison between the returns of those companies involved in the semiconductor industry against the broader market. And you can see on the left-hand side, up until May, huge enthusiasm for companies like NVIDIA and ASML, those companies that had forecast and were expected to see really quite significant demand for microchips off the back of the AI revolution. And I'm sure you will have seen things like ChatGPT and the emergence of AI infrastructures really garnering a lot of enthusiasm from the market for what is expected to be another sort of leg of the digital revolution. That's petered out quite a bit from May to July, and it sort of indicates that investors' markets don't really know what to make of AI. And it does chime with what we saw at the back end of the last century, where you had the dot-com bubble, where everybody was well aware that the internet was going to be revolutionary for how we all lived our lives and how we worked. But nobody was really sure how to play that from an investment management perspective. And I think you're seeing a similar thing with AI. I think there are a very, very small number of people who truly understand what AI is, what its implications are, and what its applications are going to be. And therefore, albeit we know it's going to be a very significant development, nobody really understands how that's going to benefit corporates and indeed companies within the tech sector. But nonetheless, you have this element of not wanting to miss out. So a lot of money going into tech, and in particular into semiconductor producers in the first half of this year. But as we say, that has now started to peter out. But actually, if you look at the broader market, the S&P 500 on either an equally weighted basis, or you strip out the tech sector itself, it's done very little. It's been very sideways moving. And we know, we've done some analysis around this, that where you see this sort of narrow market, so a market that's led by a very small number of stocks, that gap tends to close between those that have done very well and those that have moved sideways. And generally speaking, it doesn't tend to close by the rest of the market catching up. It tends to be in the opposite direction. So we're a little bit circumspect about some of those valuations in the US moving forward, and suffice to say, there may well be better opportunities elsewhere geographically. So nonetheless, this is despite, if we can just go back one, please, Jordan. Thank you. Despite the good returns, it's not an easy market to play. And this is demonstrated by the volatility, not just in equity markets, but also in bond markets. What we're looking at here, it gets a little bit technical, but we're looking at the difference between the rate at which you can lend to the US government over 10 years and the rate you can lend to the US government over 2 years, what we call the yield curve. And you can see that the extent to which the yield curve is moving around is really quite high. So you've got spikes around October 2008 global financial crisis, and again in 2011 the Eurozone crisis, where the levels of certainty on interest rates and interest rate policy are very, very low. Look at where we are now at the far right end of that chart, and you can see we're starting to get to that level. We're nearly as high as we were in the Eurozone crisis. And that just really indicates an extension of what we've seen over the last year, that markets are really unsure what is going to happen with interest rate policy. Now, in the short term, there's actually quite a high degree of certainty on that. We got a decision on interest rates in the US today. We expect them to go up by another 1/4 percentage point. And then maybe one beyond that later in the summer. But beyond that, there's very little certainty, and in particular as to when interest rates might start to fall. So in the US, at least, they have inflation to some degree under control. The latest inflation number came through at 3%, the core inflation about 4.7, but definitely the direction of travel is downwards. Whether or not it'll get to that 2% target in the short term is quite another matter, but the direction of travel is very clear. So we expect to see one, maybe two more interest rate rises in the US. The big question on what's giving rise to this uncertainty is what happens thereafter. Is there going to be a cut in interest rates this year, next year? We think probably not. It's always difficult to know because interest rate policy suffers from what is known as long and variable lags. You make your interest rate decision, and then there is a period of time, maybe 9, 12, 15 months before that decision actually flows through into the real economy and you start to see its effects. So with that in mind, there is this degree of uncertainty about when the cut will come. We're more inclined to think that interest rates will stay at this higher level for a period of time, possibly to the back end of 2024, maybe early 2025. And the reason we say that is because, as we were talking about earlier on with the Silicon Valley Bank example, central banks are now reasonably comfortable that if they do see stresses in the financial system, they can deal with those in a very targeted and specific way without actually having to depart from their general policy on interest rates or indeed quantitative easing / tightening. So markets probably a little bit more optimistic than we are on when interest rates will come down, but we think we've got a fairly resilient economy. Yes, in the US, also to an extent in the UK, albeit growth in the UK is not particularly exciting, it is showing signs of resilience. So we think we're going to see interest rates staying higher for longer and possibly this volatility continuing. And that's illustrated on the next chart, where you can see that the difference between what the market thinks about interest rates and what the Fed is actually telling us they're going to do about interest rates, there's been a divergence in that around the back end of last year. The green line is where interest rates have actually been. The dark blue line is what the Fed has been saying. And you can see there's a very clear correlation between those two. The Fed has been very good to its word. It has done what it has said it's going to do, and there have been no real surprises. But for the last 6, 8, 10 months, the market started to think inflation is coming under control. There's no reason to have more interest rate rises, and has started to deviate again from what the Fed is saying in terms of expecting either an earlier stop to inflation, to interest rate rises, or indeed a cut very shortly after you get to peak rates. So a good market, but certainly not an easy market. A lot of question marks around valuations on equities, and as we continue to stress around interest rate policy. So that's the overview of what's happened over the last few months. George, let me pass to you and you can talk us through what's happening in economies.
Thank you, David. Before we start, just a comment on some of the things that David said, because as he was speaking, I came to a realization. So my generation, I'm 44, my generation grew up playing video games. In fact, still when I relax, I download the latest thing on PS5 and play with it now that my kid is a little bit older and doesn't get scared that easy. And we grew up with a certain set of movies and a certain set of love for a certain love for video games, and technology was really integrated in the way we're being brought up. Now, why am I saying this? My generation is also the average age of the fund manager, which is 43. And throughout our lives, we have been primed, we've been conditioned to expect an AI revolution. You know, it's all the movies, it's the Terminators, it's the Matrices, it's all that. And of course, we understand it's only movies, but the world is progressing towards something that we think we're very familiar with. Now, if you're wondering why the AI rally happened, this thing might not have happened 20 years ago. Okay, we had the dot-com bubble, which was completely different thing in terms of, you know, how people viewed the world, and still it was a very big thing. But for my generation, this kind of thing has been expected for years. So it's natural when you see ChatGPT answering to you, you get all excited and you wait for the next thing. Because let me share a little secret. Markets, first of all, markets aren't that smart. Markets are herd. Okay, and there's a lot of fear of missing out. So if a lot of people go into something, other people follow. But more important, markets are not all wise. They're not all powerful. They're made up of people, and all it takes is a small group of people to start something, and everybody else starts piling in. This is literally the history of financial markets in the past 5 centuries. So what I'm getting at is, because my generation is so primed towards this AI thing and towards this tech revolution that's always coming in one way, shape, and form, it's natural that we might be overreacting. So the technology doesn't seem to be there yet to justify all these expectations. Okay, there's a rapid technological expansion, but you know, nothing really significantly changed from November to today, not in terms of what technology can do for you. So keep that in mind. Actual technological advances take time. Markets, on the other hand, could be celebrating for 6 months, take everything sky high, and then get disappointed that the next new thing is not out. So keep that in mind, because I think, you know, we could very well be reaching that stage. Don't take anything my generation has to say on the potential of AI as law. We're very biased towards this thing happening. Now let's talk a little bit about the economy. Forgive me that small rant. The inflation is sticky. So yes, we got inflation down, especially in the US, down to 3%, in Europe down to 5-ish. Let's not talk about the UK yet. That's a different circumstance altogether. But getting it down from here is difficult. Core consumption inflation in the US is still 4.5%. And that's the Fed's main gauge of inflation, by the way. So we have consumers spending because they have a lot of excess money still from the pandemic. And again, to quote somebody who has been smarter about me on this, David Baker, 2 years ago, in fact, who said that when this whole thing is over, you should expect one big consumer party. And, you know, as I see the numbers, this sort of thing comes back to me. I'm naturally a very cautious person, so I didn't believe this would be happening. I thought, you know, we'd be mourning the dead or whatever. But actually, David was right and I was wrong. This is the consumer party we're looking at. And even if people don't have money, or where they have any excess savings, they want to make up for the lost time. Okay, and by the way, sort of thing happened also in the 20s, where we had a lot of good stock market returns too. Now it's more sticky in the UK. Why? Because the UK is a lot more service focused. B, the jobs market is a lot tighter, and C, the UK has a lot of oligopolies, especially in banks and supermarkets, and that is also causing a delay in transmission of monetary policy, because banks won't give you a better rate, so you don't have any incentive to save rather than spend. And B, also in supermarkets, because you have to pay more, and if it's 5 supermarkets owning 77% of the market, then you have a problem. Now, the global economy is tight, and it will get a lot tighter. Why? Because this thing should have happened in H1, in the first half of the year, but right at the back end of the previous year, China decided to abruptly reopen. So what was going to happen at the beginning of the year now looks like to be happening in the second one. We have manufacturing slowing down, and we have services still expanding but slowing down too. And we have interest rate hikes, and for interest rate hike to work, it takes a year. So if the Fed hikes for the last time in September, expect September 2024, where you see less tightening in financial markets and the real economy. From where we are today, the Bank of England could hike anywhere between 3 and 6 times. I wrote this 5 days ago, but it keeps changing. The ECB is probably going to at least hike 2 more times from where we are now, although they have been a little bit dovish lately, and the Fed could possibly hike 2 more. So we have tightening ahead of us, and we have quantitative tightening. We have banks not lending out that much, so credit conditions are tightening. We have a slowing economy, so expect a rough economic environment in the next 3 to 4 quarters, say. Equity markets are bullish, but as we said, so far they've been running on a very narrow leadership. That's not necessarily a bad thing, by the way. Those crocodile mouths, as they say, where you have one sector pulling up and everybody staying, can close 2 ways. Either the stocks that have outperformed will start underperforming, or the stocks that have underperformed will start outperforming. So in all this, we expect volatility to still be the theme of this year. And we have quantitative tightening, and we have tighter rates, so expect financial markets to be volatile. This is what you definitely need to know. This is your big takeaway from this session. What you need to think about is that the case is that the economy will slow down, because this is exactly how central banks want it. So, in case you would be more optimistic about this, and you could be for any particular niche market, not everybody follows the big trend. Just keep in mind that right now the government and the central banks are not your friend in terms of economic growth. Quite the opposite. Fighting inflation is the priority. Now, for the UK, which is slower growth and higher inflation than everybody else, expect some sort of a recession. Experts call it a shallow one. I'm a little bit more skeptical, because once we enter the recessionary cycle, much like when we enter the inflationary cycle, you don't know exactly how it's going to play out. So things aren't linear. And things that you don't need to know, but I'm going to say anyway, is that also the US might have a recession soon, might or might not. It's still, I think it's going to be a close call, and the EU also will likely face zero growth or maybe a shallow recession. But the UK is worse off, make no mistake about this. Next slide, please, Jordan. So this is our risk monitor, and I have moved the needle. Actually, the arrow is not very reflective. I've moved the needle from somewhere between even and elevated, so slightly more towards even risk. Why is that? We have all the issues I mentioned: slower growth, bank tightening, valuations are not really that low. The rally has been very narrow, and markets really haven't been paying close attention to what the Fed says. But there is still a lot of residual liquidity. We are close to peak rates, especially in the US. And more important, the central bank fought off a banking crisis a few months ago with a lot of success without compromising its rate hike path. For me, that's a big success, and I will be the first to claim to say I was wrong on this, because I didn't think they could do it. I thought they'd have to back off interest rate hikes, but they managed to do it, and we'll talk a little bit more about that. Next slide, please. So This is where marketing and I parted ways. I had an image of a bazooka and a sniper gun, but the powers that be felt that that might have been too aggressive. So the central bank had the proverbial bazooka. What is a bazooka? You know, it's a big gun that you carry on your shoulder and you shoot at things and they just blow up. The whole point of calling monetary policy bazooka is that the money was very dispersed. Okay, it was a very big bang and it affected all sectors of the economy. Now, what they did with SVB, they issued a lot of credit lines to all the struggling banks. This was changing the bazooka to a much more focused strategy, what I would call, for an analogy, a sniper gun. And this proved to be very successful. For me, it was a big bet. I had no idea whether this was going to work or not, but apparently with markets rallying, it seemed that it worked. And this has a lot of implications. The biggest one is that the markets now have the confidence that the central bank can fight off inflation and a financial crisis at the same time. If you're asking yourselves why are markets rallying right now, despite the dismal economic environment, it is the proof they got in March that the sniper gun is as good as the bazooka ever was. Okay, so that paradigm which we had for 14 years, just print money at any sign of trouble, is changed. And now we have a new paradigm which says laser focused response to all the problems, and it is working, and markets are very happy about it. This is the rally we're seeing, along with the exuberance about the AI. But it's not just that, because if it was just the exuberance, it would probably be, prices would already be down. Okay, in the past 2 months, we haven't seen an AI rally, but we're seeing high levels of return for the S&P 500 still. Next slide, please. Now, to go back to inflation, obviously it's lower, but it remains erratic. As you can see, in the US, it's sort of stabilized to 0.3 around per month. So that is still, by the way, a little bit more than 3% per annum in terms of inflation. So US inflation could be still around 3% by the end of the year if it keeps growing at the current pace. So as I said, it's going to be difficult to get it down from where it is today. Remember, the central bank's target is 2%. Next slide, please. In the UK, to get to 3.5%, prices would need to freeze today across the board. Our best guess is anywhere between 5 and 6% until the end of the year. So a bit around double that of the US. It has fallen, and the last number was encouraging. It was 7.9%, but it's still very high. And the central bank has a lot of work to do in terms of interest rates to bring it down. And what we mean by that is hurting consumption. Next slide, please. Where we are, the UK is expected to hike, as we said, 3 or 4 more times this year. The US 1 or 2, and the EU probably 2. Next slide. Now that was because we keep talking about interest rates, and that was just a little interlude about how interest rates really work. So there are 3 primary channels from how interest rates work. First, there's mortgages. You put up people's mortgages, they have less money to buy. That means they won't keep pushing prices up, especially for things they don't need. So discretionary spending would be the first to go, in theory. Then there's a savings rate. If they give you a higher savings rate, that means less incentive to spend. Therefore, again, that hurts consumption, which means that prices are kept at check. Finally, there is corporate borrowing. If interest rates are higher, then corporations have to pay more for their debt, and a lot of them are indebted. So they can't afford to give pay rises to people who need them to cope with inflation. So these are the 3 main channels. And from what we're seeing, except for mortgages, the other 2 channels have a problem working. Why? Because the savings rate hasn't gone up. The government has been pushing banks to give something better. And this is a global thing. It's the same debate they have here. And also, despite the high levels of corporate borrowing, A, we haven't seen any major defaults, and B, what we also haven't seen is weakness in the labor market and downward shift to earnings. So companies are still paying their employees enough money to stoke inflation. So the transmission policy, i.e. we're putting up interest rates, is probably not working exactly as the central bank would want them to do. And that is why inflation can be persistent, and that's why it can be difficult to get down. Next slide, please. So this is where we are in our usual recession clock. Just for those who haven't heard it before, this is a cycle. Central banks can have years of very low interest rates. We had 14 years the last time. At some point, you get inflation for whatever reason. I'm not going to go into whether QE caused it or Putin or something else. Then the central bank needs to tighten interest rates. The first thing that goes is the stock market. That was last year for us, and the bond market, and then the economy. So this is where we are. Interestingly, this part is lasting much longer than I would have thought. It started in H2 2022. We have entered H2 2023, and the clock is stuck in that phase. We're not yet in the phase where the economy, either because the economy has slowed down or because inflation has dropped enough, where the economy is a bigger concern than inflation. For central bankers, fighting inflation is still, and beating inflation down is still their primary objective. Next slide, please. Now, as we said, at least as a result of higher interest rates, the global economy is slowing down. On the left-hand side, what you can see, the thick blue lines are global manufacturing, and as you can see, they're into contraction territory. That's the red. The light blue lines are services, and they've been keeping up the economy, but they're slowing down. In the right-hand side, you can see just the US, so the biggest economy in the world, and you can see that services are also entering contraction territory. Okay, so we are seeing a global slowdown, make no mistake about it. Next slide. And the engine of global growth, which is China, is also slowing. There's been a lot of literature lately about China slowing and whether we're going to see more stimulus out of China to help it grow. So the two biggest economies in the world, the US and China, are seeing a material slowdown, and as we can see, services have started to retreat as well. So that's why we're saying H2, the second half of the year, might not be as good as the first. Next slide. And this is the absolute greatest predictor of recession, at least according to our quant team. It is the yield curve, the difference between the lending for 2 years and 10 years. Normally the 10 should be higher. If it's inverted, if the 2 years is higher, then that predicts a recession. And yield curve inversion is the biggest we have seen since 1981. So, make no mistake, there are plenty of things signaling slower growth from where we are today. I think that point is well made. Next slide. What is still holding up is consumption. On the left-hand side, you can see a great graph by BCA, which I didn't hesitate to nick. And they say that, in essence, excess savings for American consumers will end sometime between September 23 and June 24. If it's the first, then, I'd say September, October, November, then I'd say, we will see material slowdown in the second half of this year and probably the first half of the next year. If it's a second, then we could see growth sluggish, a little bit better than expected and sluggish, but you could see also a protracted slowdown well into the back end of next year too. Next slide, please. So, takeaways, we've said them, I just need to repeat them. Inflation is sticky, and central bankers will do anything that's needed to bring it down. They will do this by any means necessary. Two, don't expect rate cuts until the beginning of 2025. Best case scenario is the back end of 2024, unless an accident happens. So that's not going to be good rate cuts. Credit conditions may continue to tighten at least until September 2024. The UK is in a worse economic position because it has higher inflation and lower growth. Having said that, portfolios move differently. Those of you who have investments, remember one cardinal rule: the economy is not your portfolio. So the success of the central bank sniper gun means that the risk of a severe financial accident is lower. Why? Because it can fight off the simple events like the US peripheral banking system collapsing, okay, which was not so simple, it was a big thing. So it will really take a big financial accident, and these don't happen in isolation, they need evolution. The central banks have shown that they're going to step in the minute they see smoke. So markets have a safety net. And that is really all they needed to keep investing. So keep that in mind, because in essence, because what the central bank did in the US worked, we get rallies today. Maybe not big rallies, maybe definitely not a bull market, but we have a good safety net. So if you're an investor, you should really consider this. And from here, I think we can open it up to questions.
George, thank you very much indeed, as ever. We've got 7 or 8 minutes maybe, so let's try and squeeze some questions in. I can see quite a few coming through, so forgive me if I don't get to everybody's question. But let's start with this one, George, which came in advance and is about the national debt. And we talk about debt a lot. Indeed, the pandemic caused governments, necessarily to increase their debt just to support the economy when everybody was in lockdown. But the implications of that are quite significant. So the question is, the national debt is now standing at £2.6 trillion, increasing substantially over the last 20 years. So 3 questions off the back of that. What is the annual cost of servicing this debt? And then when and how will it be reduced? I mean, as far as the first is concerned, there was a timely report from Fitch earlier this week, which estimated that the UK government during 2023 will spend £110 billion just on servicing the interest on the national debt, which is a big number. But probably more scary than that is the fact that that's over 10% of government expenditure, which isn't going to the health service or education or wherever else people might think it ought to go. It's going on the servicing of debt. So, George, how does this situation resolve itself, if at all?
Okay, so for actually getting the cost of servicing that debt down is not too difficult. We just need to get inflation down. Why? Because UK debt, especially in contrast with many other countries, a lot of it is inflation linked. So that's why it skyrocketed very quickly, which means that if inflation comes down, then the cost of servicing that debt will come down as well. Okay, that's not the hard part. The hard part is reducing the debt overall. Now, asking the Greek how we reduce debt might be considered an irony, but in my humble experience, and I'm not talking the Greek experience, obviously, but in my humble experience and all the things I read during the past years, because I was wondering the exact same thing you guys wonder about, and the answer is that generally speaking, debt tends to go one way, tends to move in very big cycles, and at some point there is a debt bust. And I have no idea what sort of, these are century, these events happen once a century, those big debt busts. They're usually linked around wars or stuff like that, when big countries would start default on their debt. So I have no idea what the next debt bust is going to look like, but what I can say is that we used to think 100% debt to GDP is going to be catastrophic, or 90%. Now we are at 120%, and we're living big and happy lives. As a Greek, I love it, because it means that there are more countries now that are heavily indebted. So a lot of countries, big countries, we have a lot of allies in the debtor camp, which was not the case 10 years ago. And that is the larger picture here, isn't it? The UK owes a lot of money, so does the US. China has a lot of internal debt, believe it or not. So there are a lot of debtors out there. And that if I was a creditor, If I was the person who lends out money, I'd require a yield. And that's why yields are higher. So expect debtors to be paying more on their debt, which means expect higher bond rates. But as to when and how the cycle will burst, these are very big changes in the world. And as I said, usually it happened around the war. So I'm hoping this time around it's going to be different.
Well, yes, I mean, that's absolutely true, isn't it, George, that where you've seen debt get to levels, you know, relative to GDP this high previously, that has been associated with wartime spending. And what tends to happen, and what I think is the optimistic outlook, is that you get economic growth maybe coupled with some inflation that effectively devalues that nominal debt over a period of time. So the nominal number, I don't think, is going to come down quite significantly anytime soon, but perhaps relative to output, it could shrink. It's an interesting point you make about the inflation linking of UK debt. Around a quarter of UK debt is RPI linked. Most countries don't do that. I think Spain is the next highest at around somewhere like 11% of debt. So we're a little bit unusual in that regard. Okay, let's move on. George, what will the key drivers of UK exchange rates be over the next 12 months? And if you're holidaying presently, you'll know you get a little bit more, a few more dollars or a few more euros for your pound than you used to. The sterling's been pretty strong. So
interest rates. Interest rates, interest rates, and interest rates. The sterling has been strong because we assume more rate hikes in the UK than the US or the EU. So interest rates, interest rates, and interest rates. The higher the inflation, the better exchange rate you get. At least you get a better holiday in Greece, which I don't suggest, by the way. We get lots of fires and climate change here is killing us. At least though we get Michael Gove to visit.
Super, thank you. And of course, interest rates being intrinsically linked to inflation. Let's squeeze one more in, and a question that's just come in about markets and really about asset allocation and choices between investing in bonds over equities. And you know, those of you who are with us who've invested in our portfolios for some time will know that we favoured equities for a long time because there was simply no return to be had from bonds because interest rates were so low. That situation, George, has now changed, and the yield you can get, as you implied earlier, from bonds that much greater than it was, and indeed higher than you're getting the dividend yield on equities. And that's really changed the dynamic, hasn't it, for investors? And indeed, we've changed our strategic asset allocation in the last month to acknowledge that.
Yes. So generally speaking, bonds have yields. Good thing. Equities, without quantitative easing, don't expect equities to give you what they gave you in the past few years. You know, that 12%, 13%, 16% per annum, probably not the number you should be looking at. You should be looking closer to an 8, which is still a great number, by the way. Okay, we shouldn't get too greedy about that. And bonds have a yield. So as you said, David, on the back of this, we had to change our strategic asset allocation, and also we had to make a lot of tactical decisions. Remember that huge underweight we had in bonds, which we closed down. I think it was late last year.
Yeah, absolutely. Thank you, George. And fundamentally, we are now very much in a different market for investors today than we have been over the last 15 years. You know, there was lots of commentary about, you know, are bonds actually investable? Is a traditional 60-40 portfolio still suitable for most investors? And I think in many ways, you know, the pandemic and then the inflation that arose out of it in conjunction with what's happening in Ukraine has sort of forced the issue back to something that looks a little bit more like normalcy. So we've been moving a lot more into bonds, short dated admittedly, because of where the yield curve is. We think you're getting paid very well with lower levels of volatility being in short dated credit and short dated bonds.
David, sorry, can I add just one thing here?
Please do.
In my 20 years and your 20 years, David and I are exactly the same age, by the way. So in my 20 years and your 20 years, what we have seen over time is a lot of people calling for the end of normal investing and the end of fundamental principle as we knew them and all of that. So I'm sorry, but I'm starting to call a little bit of BS on all that, because it's just not happening. Good fundamental principles may develop. So we didn't always have the market portfolio and modern portfolio theory that developed in the 50s, and we didn't have good fundamentals, you know, in deciding how we buy things. That's also a creation of the 60s. But we've only had changes positive. We haven't had anything that has fundamentally demolished the fundamentals by which we invest. So we need to keep that in mind, because you mentioned the 60-40 portfolio. This is a very fundamental thing. What it says, have half your money in equities, half your money in bonds, or thereabouts. This is a very fundamental principle. And I've heard, you know, all the calls, yeah, well, crypto is coming and AI is coming and we need to change the way we think and all that. If you're a long-term investor, don't fall for that. You know, for a trade, you can follow any story you want, and you'll probably be the wrong people to ask. But for a long-term investment, don't fall for the narrative that those things are out of vogue and will never appear again.
Thank you, George. I couldn't agree more. And with that, let us leave it there because we're a little over time. Thank you very much indeed for choosing to spend your time with us this morning. We do appreciate it. We hope it was informative and interesting. If you have any other questions or want to get in touch with us to talk about anything in particular, please do so. Otherwise, we look forward to seeing you again in September. Thank you very much.